Hello traders, welcome to FreeFX. I'm Francesco, and today we have a very exciting video because there's quite a lot happening in the markets, so I just wanted to kind of go through that with you. And just quickly a disclaimer there for you. Okay, let's move on to the topic of the day, which is risk on and risk off. We're going to discuss quite a few things today, so I'm just kind of close out and show you. First of all, let's start with the this chart here, which is showing quite a few things. Two things, obviously, the lines that you see are the close lines from a monthly for gold spot, which is the obviously gold color, orange. And the other one is the 10-year treasuries from the US. This is the actual yields rather than the price, which is obviously the opposite. So what you can see here is, first of all, let's hide the treasury yields. You can see gold price from just before 2007, so we're looking at about 14 years, and you've seen this spike here, which I've mentioned before. Now this is the actual close line from August 2011, so we're exactly 9 years ago. I mentioned in another video, my gold video a few days ago, that essentially if you look at the actual candles, you can see that the high here in August 2011 was about 1921, and we are back exactly on that line. So this month we kind of been trying to get sort of over that line and then sort of come back to it and bounced up and down. So it's a pretty inconclusive month in terms of this particular level. We just seem to be closing above it at the moment, but this is a very important kind of level. So if we sort of start closing below it and return, that's quite an important sign for gold traders, but for other things as well. So I'll go back to the line view because that kind of makes it easy to compare with the other one. And then we see the other thing, which is gold is a safe haven. It's the go-to place for risky markets. So title of the video today really is, what is the sentiment at the moment? Is it risk off? Gold seems to be suggesting this, but I said before that when we compare gold with the S&P 500, we've seen a strange correlation happening through the COVID pandemic outbreak, sort of February, March, where they've been moving in tandem pretty much. So let's show you again the 10-year treasury yields. So this is the US government bonds, it's the yields. So they've been obviously declining, and we are at pretty much an all-time low. And I will show you in a minute something a bit more long-term about that. But you can see that they obviously move in sort of opposite direction. If you look at this arch from 2011, we just mentioned, to 2013, a 2-year period, kind of moving in opposite directions. Then again, mirror version of each other. And this particular extreme is a sign. Now, obviously, we can expect that when yields are very low, bonds are quite expensive, therefore they're not as attractive, clearly, and people head off to pour into gold. I was reading that since the pandemic this year, gold ETFs have gone up something like 28%. So there's been a huge shift of investor sentiment towards gold and precious metals, and that's all I want to say about that. But if we go on to this chart here, this essentially is a comparison chart from Trading Economics, an excellent website if you've not been to it. You can compare countries' statistics from GDP to interest rates and actual currencies. So what I've got here is a chart showing you the blue line is the 10-year US government bonds, and it's the yield, which, as I showed you from 2007 on, have been declining. This goes back even further, and it shows you basically all the way back to the 90s, and the trend is the kind of straight line. Obviously, you can see that. So anybody with an eye can see that the yields have been fastly diminishing. The dotted line is a US federal funds rate, so the interest rate in the dotted line. You can see that Obviously, the Fed monitors the government bond yields closely, so its interest rate changes are taken with a view as to where the yields are. So you can see that in the changing landscape of central bank interest rates down to these kind of historic lows, 0, and then raising them again hasn't really turned the tide, and then we return to kind of 0 regime. So all of this hasn't obviously helped the yields. As you can see, a trend is also in interest rates kind of declining over time. Right, so we could say, well, from this chart, obviously, if we were to invest in gold, we have these sort of highs, and as I said, it's a pivotal moment. If gold starts to decline, it's a big sell-off, maybe the yields will start. Chicken and egg, remember? Never assume that one is correlating to the other perfectly. But certainly, by sort of historic prevalent, this might indeed be the case if you see yields rising again. You could expect gold coming down, but obviously, let's look at the more short term and look at gold from the futures side. Here's the futures. This is the hourly chart. Show you hands at the top. Actually, it's a daily, but I want to show you this because well, you can see the volume here. The sell volume is quite fantastic. There's the 11th of August, which was Tuesday, and of last week, and then Wednesday today. There's your sell volume. Now, obviously not the same sell volume, but even so, this one was a big decline for gold, and back to these sort of, as I said, 1921 sort of August of 2011 levels. And today, after a few days of trying to get back up, again, other big sell, and it's gone down to the same level again. We had about a week of indecision trying to get off this former resistance, possibly new support, but we kind of stuck to it. And that's all I was going to say about that. So bit of a conundrum there if you are a supporter of gold, and that's tricky. But let's kind of think about that for a second, because if we go back to this chart here, I was going to show you the take off the US Treasury yields for a second and show you the Euro USD, because this is the monthly line. Obviously, lots of years kind of condensed into one. And I said before that we have a correlation between euro and gold recently, where the euro has been rising steadily, and so has gold from March. So the pandemic has kind of streamlined euro, S&P 500, and gold in a strange way. Obviously, the helpfulness or not of this correlation is up to you. Truly, if you look back, as I said before, gold is at an all-time high. As I said before, using fxtop.com, it's a long-term trend that seems to be kind of going up and up from the 50s, in fact the 70s for gold. And Euro USD, we're not at these highs of 2008 before the crash. Indeed, there is room to the upside, but I also said that this trend channel for euro indeed shows one or two problems, because we have this upper channel top and we're just on it. And I said before that if we look at the candle side, we should really see apologies, we should really see a close above it, and I have a problem with this because the monthly candle for August is not particularly closing above 118 sufficiently to say that we've cleared this top channel. and I've drawn that before. If you look at my video from even yesterday, you'll see this channel top, and I'm going to draw it again. I haven't saved that chart actually. I tend to make new ones as I go. But that means that 119 close. If we closed above 119, maybe we'll clear that. Remember, this is a monthly from 12 years, so it's quite elastic when it comes to precise numbers. I wouldn't stick to 118 as a sort of brick wall. Now, talked about gold futures there, and I'm going to go to the euro futures, and this is actually the hourly for euro futures, CME Group, and September expiry contracts. I was going to show you this because the sell volume today alone has been quite phenomenal, and it's the highest. If you look at the size of that sell volume bar, it's just short of this big sell here. Now this sell back in at the beginning of the month, the 7th of August, at the start of the day, that would have been the Friday, was actually from about 118.30 something, so below 118.50 essentially, back down to be just below 118. This sell today essentially is from 119 to about 118.50. So we are kind of at the same point as the start of the day on the 7th of August. But a massive sell there. And what is the cause of that sell today? Well, the cause of that sell today probably, clearly, is this would have been the Friday of the non-farm payrolls. Okay, so just saying that's kind of what the slight upbeat, etc., but then kind of mixed data, and so not particularly conclusive for the US dollar. But today was the day of the minutes from the Federal Open Market Committee, FOMC, from the last meeting, and there's been talk about why the euro has declined today. The euro is sort of streamlined at the moment with the S&P 500. As I said before, there's a correlation between risk assets, or sort of capital markets, meaning basically stock market, etc., and the euro. So important to sort of there's not been an update from the Fed's point of view, but there's been a lot made of the text of the so I've got it here. This is page 7, I believe. Yes. Just to go to the top, this is the actual document, the minutes. There you go. So it does actually give you some. So there's been some talk about this being a document that highlights the Fed's preoccupation with the capital markets valuation. So here's a bit highlighted in blue, which is that essentially the S&P 500 has done well. It's going to bounce back from its correction during the pandemic, and that's also because the S&P is supported by a significant share of technology firms. We're thinking of perhaps FANG, Facebook, Amazon, Apple, and Netflix, and Google, and you forgot the geos. And whereas firms that are out with this index have not fared so well, and that's reflected in the Russell 2000 index, which has not performed as well. So the other concern, which is at page 7, is the broader financial risks to the system, and we see here that the stability of the financial system is characterized by vulnerabilities of the US financial system, which are notable. Unusual high levels of uncertainty associated with this assessment, and asset valuation pressures were notable, especially commercial real estate prices, which were continuing to increase despite rising vacancy rates. And it also says that there is basically financial leverage, which is vulnerable due to declines in household incomes and business profits, which means less resilient borrowers. So essentially we have the Fed sort of launched renewed stress tests for its banking sector for the US banking sector during the pandemic, because they wanted to be sure that there'd been sufficient capitalization for banks. But it's actually the secondary market, so it's the actual consumers, say mortgage holders, homeowners who have maybe lost their jobs during the coronavirus pandemic, or they've not been essentially covered for their losses due to loss of hours or income and revenue, etc. This means essentially we are, in theory, back in a 2008 situation where the housing market is healthy, but it's over-leveraged in terms of the underlying asset, which is not the home, but the people buying the home, who are less protected or secure in their employment. So there's more an increased possibility of default on mortgages. This would be disastrous, obviously, to have another bubble exploding under the Fed's watch, considering how much work has been done. There is more information if you want to read this, but I'm going to kind of close it here. But essentially, there is a challenge as well in the consumer spending. The last quarter essentially has been actually lower than previous. So personal consumer expenditure, PCE, is the one that the Fed watches, and that's actually below what it should be, which means that there are worries and concerns about the labor market and also the resilience of the financial system as a whole. So this is what actually has turned the euro down today. If I go back to this chart and show you the euro again in a sort of hourly form, you see the decline there. So we've had this. Actually, the clock ticked at 7 for the Fed minutes, and there was an uncertainty candle there. You can see that. There's your candle there. So this is the 8 o'clock, so after the minutes. So we had a high of 119 almost, and it went down all the way with a long wick to 118.30. So a good range for one hourly candle, and it kind of we settled for the end of the day now about 118.50. I talked about the options open interest yesterday, so I'm not going to talk about that again. But essentially, because of that long-term trend channel and lots of other things, we are in this uncertain thing. So yesterday, I talked about the Euro rocket, looking like finally we're getting some traction. But always warning with caution about that, and my caution was indeed justified, because here we are today, back to below 119, and all that good work has been undone by essentially words from the Fed, but not much else. I'm going to stop here. Very long video, I apologize, and I appreciate your comments and your patience. Please like, subscribe, and let me know what you think of these topics. Take care and watch out trading out there. See you in my next video. Bye.